Hello, and welcome to our next session on BNPL, Buy Now, Pay Later. My name is Jennifer Tramontana. I'm coming to you live from Austin, Texas this morning for me, afternoon, evening for many of you. And I am lucky to be the moderator of this session today. I'm the president and the founder of the Fletcher Group. We are an agency that works for fintech and payment companies on their brand positioning and brand awareness, and have been doing it for about 16 years. And I'm also a proud Canadian who is the executive director of the Canadian Prepaid Providers Organization, and we are representative of the prepaid technology industry in Canada. I am joined by three BNPL experts who are going to chat with you for the next 30 minutes about what's going on in this incredibly dynamic space. So I'd like for each of them to introduce themselves. So let's start with Benjamin.
Hi everyone, Benjamin Quinlan here, CEO and managing partner of Quinlan and Associates. We're a strategy consulting firm specializing in the financial services and fintech industry. I was the former chairman of the FinTech Association of Hong Kong. I also chair the Innovation and Technology Committee at the Australian Chamber of Commerce here in Hong Kong, among various other bits and pieces. Obviously haven't been able to leave this city in a while, so making the most of everything virtual while I'm stuck.
Well, good. Glad we've got you in a captive audience. Tim, could you introduce yourself?
Thank you, Jennifer, and thank you everyone for having us here today. So I am Tim Russell. I'm joining you guys from London. I'm the global head of strategy at Laybuy. Laybuy is a buy now, pay later firm started in New Zealand, and we offer a 6-weekly installment product in Australia, New Zealand, and the UK. So very much looking forward to the discussion today with these two experts and yourself.
Excellent. And we hope you have air conditioning, Tim.
I do. Yeah, I've needed it up the last few days.
Yusuf.
Great. My name is Yusuf Osdalga. I am the head of European investments for QED Investors. QED is a global fintech VC firm investing in North America, LATAM, Europe, Asia, and Africa. We have invested in about 140 companies over the years, including in Klarna, which is buy now, pay later, obviously, as well as Green Sky. So we've done a lot in this space, and we continue to be experts in fintech and look at all things fintech and lending.
Great. Well, thanks so much for all of you for being here today. For those of you watching the session, if you have any questions for the panelists, we will leave a few minutes at the end. But if you want to just pop those questions into the comment section or the chat, we'll make sure that those come over, and we'll either work them in throughout our session here, or we'll save a few minutes for the end. But we do want to hear from you and would love to answer your questions. Okay, so let's get started. And Tim, I'd love for you to kick us off, because you're obviously the representative here who's, has founded and is running a buy now, pay later entity. So the way that I, and many folks look at BNPL is it's really, the benefit of establishing that credit relationship with the customer to deepen that, overall relationship and loyalty. Similar to the old days of buying on account, right? But what I'd love for you to kick off and tell us about is, how do you think that BNPL for our digital age is really better than the other choices in payments, and why?
Yeah, so I guess the first step is in acquiring the customer in a digital age. So we found that having that financing trigger at checkout at the merchant level really drives the decision to spread payments or take up a credit product versus an after-the-fact solution or a rolling credit facility. So when you're attaching interest-free credit to specific transactions, customers feel like they can manage their money a little bit better, and then we offer them the ability to do that within their apps and things as well. So you have a fast and frictionless onboarding experience. People come in and they can attach the transaction to their debt facility, and it's a more sort of inclusive experience digitally than traditional forms of credit. But I think really where the customer has flocked to buy now, pay later, and why we've continued to be successful at driving purchase frequency across our customer bases, and that's pretty much where the real value in any sort of lending lies, is getting people to, as you said, be loyal and repeat more, is around tapping into that shopping experience, offering a cross-merchant shopping experience in our apps, and really driving a personalized relationship to the brands they're being served up there. And you're starting to see that across all buy now, pay laters, that it's not just the surfacing of a merchant into a customer's app, but it's also about other parts of the e-commerce value chain that they can help with as well. And then that's where, I think the digital age of merging both payment, credit, and actually e-commerce and shopping experience into one has really been beneficial to the BNPL companies.
Yusuf, would you agree with that? Is that where you think the value prop is? I see you shaking your head.
Yeah, no, 100%. I think buy now, pay later can be very valuable. One thing that I've emphasized in one of my recent Twitter threads was, when is buy now, pay later not buy now, pay later? Because, I bought a house recently and I got a mortgage. And you could say that the mortgage is buy now, pay later because I buy the house now and I pay it over 30 years. And indeed, on the point of sale finance has been around for a very long time. So there's certain things that make buy now, pay later what it is and makes it unique. And if you adhere to those things, it can actually work as a win-win-win for consumers, for merchants, and for the lender itself. So it can be very powerful. But if you deviate from some of those points, it can actually spiral downwards and a sort of cascading failure can occur. So if you do it, you got to do it very carefully. But if you adhere to those core principles and the market fit is there, then it can be very powerful. So it's a little bit of a case of the devil being in the details. And you need to be thinking about what those details are. Credit underwriting and losses is a big part of it. It's one of the 8 factors. And I think there's a resource where we can share that thread with the audience later if they want to look at it. And I'm happy to go into some of those details here later as well.
So 2 things. So for the audience, we are going to put up Yusuf's total Twitter post in its entirety, which he goes through the 8 principles, so you can read that at your leisure. But Yusuf, why don't you tell us the 1 or 2 or 3 that you think are the most critical for it to be successful?
Well, so to go through it quite quickly, first, it has to be free for the consumer. If it's not free, it's point of sale finance if they're paying interest, and that's fine. Point of sale finance has existed for a long time. Nothing wrong with it if you do it in the right way. But BNPL is one that's truly free to the consumer. Now, nothing can be free. Somebody has to pay for it, which is point 2. The merchant has to pay a merchant discount rate. So that's sort of 2 core elements that need to be in place for it to even be buy now, pay later. Then if you just follow the logic from those points, it needs to lead to higher sales conversion for the merchant, because if the merchant is not getting higher sales conversion, they wouldn't want to offer it. And then the 4th point that flows logically from that is it has to be a discretionary purchase for it to work quite well, because if my boiler breaks down and I'm not being able to take a shower, the merchant knows that he's going to make the sale quite easily. But if it's a discretionary purchase, anything that helps conversion is valuable for the merchant. And then the most important point I would say is it works best with high credit quality customers, or if you have a unique insight into credit underwriting, because otherwise losses can go up. If losses go up, then the economics don't work and the whole thing can collapse. So you need either a very high credit quality population or a very superior underwriting model, with the former being more likely. The other points are it has to be frictionless, and it also needs to lead to very good customer outcomes, i.e. you need to take affordability into account. So that's a long list, but a quick
Makes sense. Well, folks can read more, but I think that's a great layout. So Benjamin, here's what I want to ask you. Not the same question, because Yusuf and Tim have obviously laid out a great case for how, the win-win-win of BNPL, right? But we're in an interesting time right now. There's lots of headlines, Klarna's valuation, Sezzle having some interests, concerns about viability, new regulations in multiple countries coming. So what's happening now? Does it need to be marketed to a different subset of consumers, or does it need to be, do we need the reins pulled in? Like, what's your thought on what's happening right now and how we continue to, make sure there's strong viability for a BNPL solution?
No, very good question. So if you break up the problem, particularly with a lot of the independent BNPLs, there's 4 key areas. So consumer side, merchant side, funding side, and regulatory side. Consumer side, high credit losses. Generally, a lot of the firms that we're coming across, you're seeing excessive credit losses vis-a-vis what you would see in traditional consumer finance products. Most comparable proxy would be credit cards. Even if you're looking at markets like developed Asia Pacific, which is where I am, credit losses 1% in the credit card space, even sub that. Average BNPL maybe about 1.5 up to 2. Customer acquisition costs through the roof. So CAC has been something that a lot of BNPL firms have struggled to contain. And if you're looking at certain markets, you're also seeing user retention rates being pretty unfavorable. So a lot of consumers going on to get deals and discounts and then not going back and using that platform. After you spend that much on CAC, you want repeatability. So that's the consumer side. Merchant side, MDR pressure. A lot of the BNPL firms that first set up in many markets were charging double digits MDRs. You've seen that kind of compress. Most developed markets might be about 5-6%. In emerging Asia, it's like 2 to 3%. So razor thin. And then that merchant expansion cost is really very expensive. A lot of BD teams, brand ambassadors, everyone trying to build up that merchant base. Funding has been a pain point. These are not banks, so they don't have deposits. Typically, they get financing partners. A lot of the interest rates charged on these facilities aren't exactly that favorable. And if anything goes off on the MPL front, then you've got a problem. And then finally, tightening regulations. That's the fourth pillar, which is you're seeing that happen, particularly in markets like the UK. Australia is following suit. Asia will soon follow suit as well. So all of that is painting a pretty nasty picture for the independents. And you've seen stock prices plummet in markets like Australia, where you had 8 listed BNPL firms, down 90+% pretty much across the board. Some have been decimated, and a lot of firms are trying to consolidate to address this problem. The way I can encapsulate this is the problem is not a problem of economies of scale. The problem is around unit economics. So the unit economics of the model as it stands today does not work. And all of those pressures that you're seeing can be easily solved for or addressed by many of the incumbent firms that are starting to look into this space, namely the major banks and the global payment companies. I'll pause there because I can speak forever, but just pause there.
Well, one thing is I'll let our audience know that Benjamin's written a report on this that we are also going to have available in the chat that you can download to learn more. But Tim, I'd love to get your reaction to what Benjamin just said, both in terms of do you agree, disagree? How's Lay-By, reacting to some of the pressures that Benjamin just laid out?
Yeah, look, I think a lot of the pressures that Benjamin laid out have been sort of beaten to death, usually around the headline related to some of the more recent BNPL raises and share market pressures. And I think that a lot of them bring some pretty valid points around, especially around the unit economics when it comes to the underwriting decision and the losses. When you're offering an interest-free product, you better make sure that the right people are coming through the door. I think the one thing it misses, though, is what is the intangible value or the tangible value that you have associated with the customer and merchant sets that you've built. We've been super tied into merchant bases. We've got customers that shop with us on average 12 to 15 times without defaulting. And there's a lot of things that we can do outside of just being an installment lender. And so that's something that we've really been trying to lean in on, to help not just the unit economics of the main side of our business, but also using it as a way to drive a whole bunch of value through our customer base. If, for instance, we've seen non-lending revenue as a portion of our total revenues go from 5% to 20% in the last 6 months. So we're really focused on, really trying to drive different pieces of the puzzle for a customer when it comes to how they shop, how they want to shop. And installment lending is a great way to bring them in and a great customer acquisition lever. But there's so many other things that we can offer both our merchants and our customers here.
Makes sense. Yusuf, I see you shaking your head. What are the levers that you're looking for as an investor based on kind of what Tim said when you're looking for companies in the space?
Yeah, Jennifer, good question. And Benjamin made some good points based on the industry dynamics today. I think if I had to sum it up in one word, it would be differentiation. So I think the point I was trying to make is not all BNPL models are created equal, one. And even more importantly, not everybody that says they're doing BNPL is even doing BNPL. because there really isn't a sort of commonly agreed definition of what is and what is not buy now, pay later. But if one does it correctly and sort of adhering to the tenets of this, it can be incredibly powerful. So I don't want to give names here of companies due to confidentiality, but we've had companies in our portfolio have done it with less than 1% losses at a scale of billions, with losses being way less than 1%, and merchant conversions being greater than 60%, and the customers in most cases never paying any interest for a loan that lasted actually more than a year. So, it can be done in the right way if all the puzzle pieces fit together. Again, as I was saying, if one of those puzzle pieces fall out, though, it's not a puzzle, it's a machine, and it doesn't work without that little small cog that you might have omitted. Turns out that little one is just as important. The whole thing can break down. So that's differentiation is key in our mind.
I see some loose parallels with the prepaid card industry 15 years ago in the United States. When prepaid cards were originally came out, they served a need for underbanked consumers. It was a way to kind of enter our burgeoning digital economy, et cetera. But there was the criticism of, it was just fee-based card products. And there was, was it predatory? Was it predatory towards a certain consumer base, et cetera? It's not an exact parallel, but the industry itself, I feel like one kind of got itself together, took on some, additional regulations, self-regulated in many ways, and then also turned these things from fee-based card products for the underbanked into what is now our neobank challenger banking sector, right? That has grown tremendously. So there seems to be just some parallels there and some positivity for where BNPL might go, as Tim was saying, into it's not just about the lending, it's this gateway into all of these other, payment and financial services for consumers. Let's switch to B2B for a second. So B2C BNPL is a different, animal than B2B BNPL. And there's been a lot written about how there's a lot of opportunity here for sure. There's large infrequent purchases. Yusuf was saying over how you could say a mortgage is BNPL. Well, you could say any, business on invoice payment is really BNPL. But moving to more of an installment solution versus credit might be really valuable for small and particularly mid-sized entities. So I'm curious, I'll just throw it out to the group. I don't know if Benjamin, maybe you want to start, but what are your views on the future of B2B BNPL?
Much more bullish on that. I think from a credit risk profile, obviously it depends on the industry. I've seen a lot of this being rolled out, particularly in things like professional services, recruitment. Every single merchant out there on the B2B side, when you're facing off as a vendor, you might have challenges with regard to the payment cycle of your invoices, right? Obviously, the payer wants to delay that as much as possible. Even us as a consulting firm, sometimes we have to fit in 90, 120-day cycles, which we find ridiculous. I think what's happened as well, an opportunity that's sprung up with some of the B2C firms, is they've realized they've built some very good tech modules around eKYC, credit scoring, and so on. They're trying to use that and basically sell that software as more a SaaS-style solution to enable others to do this kind of business. So this is when you get into areas like your supply chain financing and so on, your invoice financing. I think that's quite interesting. That's one of the pivot areas that some of the B2C firms could look at as well. But I'm much more bullish and robust on this space. It's less predatory in nature. There's less of a view to actually go through and assess millions upon millions of actual individuals. And I think that the nature of this problem can be better solved because there are more integration tools that you could potentially plug into, like zero accounting software, get better views of payments to understand what is the credit risk profile. I think it can be quite enriching. I see a lot of disruption in this space.
Yeah, I'll just add to that. I think if you're doing a consumer purchase, if you're a consumer buying sneakers or something, the expectation is you pay for it now. Hence, buy now, pay later had a big appeal for consumers who could stretch their purchases. In a business context, it's almost the opposite. When businesses buy from each other, the expectation is almost send me an invoice and I'll pay it and tell me what the payment terms are. And when businesses buy from each other, that's usually the first question: what are your payment terms? So the B2B context is quite different, almost upside down in some sense, but the sort of core principles still apply. I think the first core principle is you have to define what is buy now, pay later versus supply chain finance versus invoice discounting. So that definition becomes important. And I will not go into all the details here. But the principle of if I can increase conversions to my business customers when I sell something, I'm willing to pay you as a fintech for increasing that conversion. That conversion can be payment terms or maybe financing or invoice discounting or whatever, but it can also be a better checkout experience. And when we look at B2B buy now, pay later, we focus very much on what is the checkout experience? How is it? Does it become frictionless, just like in the consumer case? So that's a core sort of question we look at. And also we do still look at losses. Does it increase losses? Can you manage losses? And so on. So a lot of parallels, but also a lot of differences is how I would summarize it.
Yeah, I mean, I would add in there as well, B2B, as Benjamin rightly pointed out, if you can get the credit decisioning right, and I think the reason why BNPL works so well on the B2C side is because of the short duration of the loans. And back to one of Ben's points as well, that helps with your funding costs because you're turning the book over quickly. You've got high velocity. But in saying that, we see a lot of value in partnering with people on the B2B side. We don't want to be lending against our own balance sheet. For us, that doesn't economically make sense. But we really look to what we're sort of terming our merchant services partnership model, where we try and introduce our merchants into those sort of lay-by trusted providers. For instance, we did a recent deal with Wayfly, it's a big e-commerce financing business. And the same can be going, people that share our same philosophy, share our same approach to underwriting, that are going to installment terms to our merchants to help solve their problems. It's part of being a good provider in that space, and being a cog that they can lean on, and that we see that brings tangible value to both our existing merchant base, and then for those that are looking to pick a BNPL provider as well.
Makes sense. Quick note to our session attendees, we are going to be coming up on our last few minutes here. So if you have any questions, please pop them in the chat now. We've got one here, but let's go to one sort of last topic we wanted to discuss, and that's the implication of big tech coming into the space. So I think, Benjamin, you had originally kind of brought this up earlier, just with the banks now coming in. What do we think about, Apple and others vying for the space? Do we think they're going to disrupt it the way they did payments, or what are your thoughts on big tech versus banks coming into the space and disrupting these more traditional players?
100%. I mean, they have all of the rails in terms of the payment networks. They have the merchants, they have the consumers. On the banking side, they have the lowest funding costs. They've got all the competitive advantages against a standalone firm, period. So the question is, what does the standalone do vis-a-vis these banks or these payment providers that is fundamentally different? It's going to be hard for the independents to work out what their proposition is. It needs to be a different kind of a risk appetite, a different kind of focus. I think the comment was mentioned around finding a niche that the banks will not touch or the payment providers are under-servicing. That's where there's scope to continue to compete. But again, a bullish view, you can't, stop the tidal wave of consumer preferences towards wanting to pay via more of an installment-based model. The incumbents recognize this, so they're just changing the way that they monetize their end consumer base. But again, all those competitive advantages are locked in place, and they're natural advantages vis-a-vis pretty much every independent in the market. So I do think they're going to make a heavy push to really capitalize on this, and you'll see a lot more consolidation and a lot of companies being pushed out who are independents.
Makes sense. Yusuf, I love this audience question. They got a bold question for you here. We want you to tell us exactly about how Klarna is either worried or not worried about Apple entering the space, but what can you tell us?
Yeah, I mean, I can't comment on Klarna now for several reasons. Obviously, we also had invested a long time ago, so we're no longer as actively involved as we were in the past. But in terms of Apple entering the space, Apple is entering the space for lots of reasons. Again, I've put some blog posts about that. A few things to note. We could have a whole session just about Apple in the space, but is e-wallets or a wallet, which is effectively what Apple is in paying, is still a very small market share in terms of overall payments. So in the wallet ecosystem, Apple is dominating versus like a Google Pay for now or Android. But wallets are very small. People still pay with credit cards at the checkout, if you look at the data. So that's one interesting thing. So you would imagine that what Apple is more focused on is actually getting its wallet to be more accepted, getting people to accept that usage behavior. And that's why they're trying to roll this out. So we'll be watching that very closely. The rollout in the US is in September, I believe, after the summer. So we'll see how that goes. Again, we've written on that for those who want to follow on Twitter. My handle is here. So that's that. And I think there was an audience question related to this on interest rates. Happy to address that now, or we can jump back to it if that's of value.
Yeah, go ahead. I'd love to get Tim's thought on that as well.
Just that point on wallets, though, I think it's really interesting because it really depends on the market. So if you look, just come to APAC, everyone that comes to Asia says, oh, Asia, it's the most heterogeneous market in the world. It's crazy. You've got, credit card penetration rate of Hong Kong at 2.7 per populace. You go down to Indonesia, Vietnam, Philippines, less than 2% of the population have a credit card. So wallets dominate a lot of the digital payment mechanisms. So I think if Apple's making a play around where it's going to drive that business, and Yusuf is 100% spot on, in the West, e-wallets, and they have a lot less impact in terms of moving the needle in terms of overall GMV. But I think if you move to certain other niche markets, in Asia, where credit card penetration is so low and digital payment mechanisms are really underwhelming, there might be a different ballgame for sure.
Yeah. No, that's a very good point. And I'll just make a very quick comment because I know time is limited on rates. Interest rates going up is obviously a challenge because now that's a higher cost and the proposition is still zero cost to consumers. So somebody has to pay for that. And obviously it has to be the merchant, and the merchant only has so much capacity to pay. Hence, yes, rates rising is a challenge. But the counterpoint also to that, not to go into, again, it could be a very deep topic. In the 90s, to take a market like Turkey, you had versions of buy now, pay later happening in a high rate environment, and merchants were paying a higher discount rate. So it is possible, but that was a unique market. Banks did their own acquiring, they were vertically integrated and so on. So not clear how we'll adjust here in the West, but it will be interesting to watch.
Makes sense.
Yeah, I would say, just coming back to my point about managing funding costs, short duration loans, we turn our book 25 times a year. So a material rise in interest rates doesn't impact our cost base as much as, say, a longer term 3 to 6 to 9 to 12 month product, which is why we've been able to keep it free for the customer. In terms of has it been thriving because of the low interest rate environment, which has been driving discretionary spend? I think that's where the key impact from rate rises will be seen amongst BNPLs. If people's ability to service the BNPL loans they've written in a period of pretty cheap money, does that then impact the credit performance of BNPLs? And that's where your ability to underwrite and pivot and see those trends before anyone else really comes into their own.
Yeah.
I think it also depends, we've never experienced this environment of trying to pass on maybe higher MDRs to the merchants and seeing how they respond. I think naturally there will be a inclination to push back, but notwithstanding that, an MDR of 5% relative to what a merchant gets is pretty phenomenal, because a lot of the BNPL firms are funding these discounts, these reward schemes, and then the benefits around driving conversion rates, driving order values, all the marketing support that's provided, that has huge value. And a lot of merchants out there are spending 20, 30% of GMV on marketing costs to bring customers in the door, right, through traditional channels. So yeah, there may be a pushback, but I still think as a customer acquisition tool, the cost of getting this done and all the ancillary benefit that come with it, it's not too bad. But we'll see how much buffer they have to kind of wear.
Well, I think unless anyone's got any other comments, I think that's a great place for us to sew up. So Benjamin, I thought that was a great kind of recap actually of everything that we had been talking about. So thank you so much to our three panelists. A reminder to the audience that we've got information from both Yusuf and Benjamin that's in the chat where you can download their writings on this and their papers. But I'd like to just thank all of you for a great candid discussion today on BNPL. It's certainly a topic that that isn't going away, and we will, I'm sure, see much more writing and speaking on this into the future for sure. So thank you so much.
Thanks, Jennifer.
Bye. Thank you.
Cheers, Tim.